All right, welcome to the final day of June 2023 and also the last day of the first half of the year. Crazy that half the year is already in the bag. We're going to be doing our monthly recap today for June. A couple of things to get into. We avoided the debt ceiling crisis. It officially got taken care of and resolved. I know it feels like a distant memory because it happened at the very beginning of June, but there's no understating how big of a deal that potentially was. Yay. We avoided the financial apocalypse. Uh, the Fed decided to skip a rate hike, but a lot of kind of quirky things are going on with the Fed right now, which we're going to be talking about extensively. Housing is starting to pick up. We're going to look at some statistics there. Mortgage rates improved a little bit. They inched down slightly as the debt ceiling concerns ended up in the rear view mirror. We're still not entirely back to basics when it comes to the markets, and we're going to be talking about a little bit of to the why there as well. So let's get into it. So the debt ceiling crisis. I know, kind of old news, but here's what happened. So on January 1st, 2023, we were set to reach our debt limit. We actually reached our debt limit on January 19th of 2023. And then they enacted extraordinary measures, which means, hey, we're borrowing from one pool of money to pay another pool of money. But basically, we were able to stretch that out. And they were originally thinking June 1st was going to be the date. Thank gosh it wasn't, because if it was, we would have missed it. They eventually moved that out to 6.5, 6.6. They kind of kept moving it back slightly as they kept enacting even more extraordinary measures to make sure that their bills were getting paid. The weekend of 6/2, June 2nd, everything got taken care of. And what they did was they suspended the debt limit until January 1st of 2025. I mentioned in my debt ceiling special update that this is going to be a recurring issue every 2 years. And it looks like that's just going to continue to be the case. They're going to continue to kick the can until the next administration has to deal with it. And the next set of House of Representatives and senators have to kind of take up the baton and deal with it. It's going to stay that way until either there's a majority in both houses that also aligns with whoever's in president. At that point, there's such a super majority that anything that needs to get passed can get passed pretty easily. And this is what I'm really hoping for, something fundamental needs to change. And by that, I mean, I mentioned also in that debt ceiling update that there's really only two countries, and we're one of them, that has an absolute debt ceiling limit. Everybody else that does have a debt ceiling limit, they attach it to their GDP, which means there is no negotiation that occurs. It's just established. When the GDP occurs, they figure out what those numbers are, and then guess what? That's how they establish the debt ceiling limit based on that figure. There's no politics involved. It's very straightforward. It's just simple math at that point. So unless something changes fundamentally like that, or again, there's a supermajority, we're going to continue to see this arise every 2 years. So it's not fun. It's not great. But at least for now, crisis has been avoided. And there's no understating it would have been a serious issue if we actually did default. So we were within a couple days of defaulting this time around. Wasn't quite as close as it was in what I think was 2011. That was when we were the closest to it, but still too close for comfort. Hopefully they come up with a longer term solution than just continuing to kick the can down the alley. All right, let's talk about the Fed. I've said it before. I'll say it again. I am a total nerd. When it comes to this kind of thing, I am a total money nerd. So here's what's going on with the Fed. So this is what they call the dot plot or the dot chart. And you're going to hear it referenced occasionally in the news. And this is exactly what they're talking about. This is straight from their minutes. So this is 2023. This is what they're expecting for 2024, 25, and then longer run. Each one of these dots represents a Fed member saying where they think rates are going to be. For reference, rates currently, the Fed funds rate currently is right here, 5 to 5.25%. When they released their dot plot, it was actually making some headlines because of these 18 dots, only 2 of them are saying, hey, we're not going to have any more rate hikes this year. And nobody's forecasting rate cuts this year. But 16 of the 18 individuals were predicting this would be 1 rate hike, this would be 2 rate hikes. So the vast majority are actually predicting 2 rate hikes this year, which is absolutely shocking. And it's shocking because inflation continues to move down at a very, very quick clip. They've made significant progress on inflation. And that's the whole reason the Fed is hiking rates. They want to hike rates because when they hike rates, number one, your savings account pays you more money. Congratulations. But the side effect is all that other short-term debt, credit cards, personal loans, car loans, home equity lines of credit, all those rates immediately increase. And if they increase, it means it costs you more money to buy goods. Because if you're using your credit card, if you're using your home equity line of credit, if you're buying a car, all that stuff has gotten more expensive. And by making it more expensive, by dissuading you from spending that money by making it more expensive and encouraging you to save money by giving you a higher rate of return on your savings account, you're more likely to save money. You're less likely to spend it. And that over time will drag the cost of goods down, right? Inflation is simply too much money chasing too few goods. So what they're trying to do is incentivize you to save money, decentivize you to spend it, and hopefully by spending less money, cost of goods starts to come down. Supply and demand takes hold, cost of goods start to drop. But again, 16 of the 18 Fed members are predicting between 1 and 2 additional hikes this year, even though inflation is coming down. Yeah, it's kind of a little bit crazy because they are hell-bent, it seems like, on just overcooking the steak. They want to turn it into a piece of charcoal. They want to make sure that inflation is non-existent. They want to make sure that there's no chance of it coming back. They are hell-bent on causing financial pain, it seems like. They are not listening to their own metrics, the inflation figures. It's just somewhat dumbfounding. The Consumer Price Index, which is, there's a lot of different inflation metrics, but Consumer Price Index is inflation as you and I, us consumers, feel it. That's decreased from 9.1% down to 4%. That's a huge move. It's less than half of what it was. They're making significant progress on inflation. Not just that, but in the last 12 months, and the reason I say 12 months is because most financial analysts say it takes about 12 months for the effect of rate hikes to actually start to take hold and actually be felt by most folks. So in the last 12 months, there's been 8 rate hikes for 4.25%. The Fed rate is between 5 and 5.25. So the vast majority of the hikes that have been done literally in the last 12 months. And there's a very good chance we're not feeling those effects yet. But the Fed is like, nope, we don't really care about, looking backwards. We're only looking forwards, and we're really concerned about what that's going to be. So again, kind of crazy, but 16 of the 18 Fed members are predicting another 1 to 2 hikes this year, which is weird also because the markets are actually predicting multiple rate cuts this year. They're expecting, hey, we're going to fall into recession, and when we do, the Fed cuts rates. So you got the markets expecting one thing, and you got the Fed saying something different, and there's just a very, break between the two, and that we're not really sure exactly what's going to happen, what's going to come to fruition of this. But there's a lot of confusion going on right now. And every single time we see progress, for instance, just yesterday, we got the final reading on GDP for first quarter, and we were expecting like 1.3, and it came in at 2%. Like, that's a huge increase. They don't usually see that significant of a rescission from 1.3 to 2%. When we're this late in the game, it's for the first quarter of GDP, but everybody started freaking out. They saw this really positive GDP number, and they're like, oh no, that means the Fed has more ammunition to continue to hike rates. They really do want to curb stomp the economy. They want to overcook the steak until it's literally inedible. That's where they're at. Home prices have been accelerating. That's some good news. So this is January, February, March, April. There's a lot of different home price indexes, a lot of different ways you can kind of try to gauge appreciation. Case-Shiller is considered the gold standard. It tries to gauge like the entire market as a whole. FHFA, they focus on, that's Fair Housing Finance Agency. They focus on lower price point, lower to mid home price point homes. Because they're measuring conforming loan limits. So 726, 200 and less. If you're paying cash for a house, it's not counted in their numbers. If you're getting a jumbo loan, it's not counted in their numbers. So these are kind of the most two that are most heavily leaned on. But you also have CoreLogic, Black Knight, Zillow, again, some aggregators out there that try to consolidate information and figure out what appreciation is doing. Every single one of them, except for one, CoreLogic, pointed out that between March and April, they actually had home prices decelerating slightly. But every other one appreciation is increasing. They all are kind of universally of that same opinion. How much, as recently as April, they were predicting somewhere between 0.5 and 1.2%, or 1.4%, I guess, month over month. So home prices are appreciating almost universally. They're all in agreement there, except for, again, that one kind of outlier. But home prices are definitely increasing. There's a lack of inventory right now. There's about half the inventory right now than there was pre-pandemic. So there's still a lack of inventory, still a lot of bidding wars. If rates were better, those bidding wars would be just crazy. I get so many calls right now from homeowners that are saying, hey, I think I might want to buy. And then they look at the numbers and they're like, never mind, I will hold off until rates drop. All those people are going to be trying to enter the market when rates drop. So once rates drop a decent amount, those people are now going to be in a position where they're no longer being held hostage, essentially, by their interest rates, and they're going to want to make that move. And when they do, lots of homes are going to hit the market. Those people are going to probably be selling their homes unless they're converting into a rental. A lot of buyers are going to be entering the market because now those people are going to be participating in the market and looking for a new home as well. So once rates break, I think we're going to see just a huge influx of inventory and a huge influx of buyers kind of simultaneously. So it might not make it any less competitive, but it certainly will have hopefully more options, more inventory, more transactions as a whole. So looking forward to July. We're looking forward to more inflation figures on July 12th. Inflation has been and should continue to come down rather quickly. Next Fed meeting. Luckily, it's kind of late in the month. And the reason I say luckily is because the Fed needs to be paying attention to the data. And right now, again, there's a discrepancy. They're seeing significant improvement on inflation, yet they're still predicting 2 rate hikes this year. Like, something still doesn't quite make sense there. The hope is that the more and more the data supports it, the more inclined they are going to be to come out and actually tell the markets, look, we're done with hikes. That's the real hope, I think. We're not exactly sure how much of an effect what we've been doing is going to have, but we know we haven't been feeling all of it yet. Inflation is certainly making progress towards the levels we were hoping for, and we don't think we need to make any additional hikes. They paused in June with the rate hike, but now that there's 16 of 18 members predicting 1-2 hikes this year, there's a lot of concern in the markets that there's more hikes on the way, and we need more guidance from the Fed. We need a little bit more direction, and right now it's kind of lacking a little bit. Markets should theoretically be getting back to basics. Now that the debt ceiling is in the review mirror, and that was really dominating everything for the longest time, we should theoretically be getting back to basics. And the reason I say theoretically is because we still have the Fed, and they're still not telling the markets to be comfortable. They're still not telling the markets that they got to hold on it, that they're comfortable with where things are at, and the progress that's being made. And then tied to that is financial institution concerns, right? We've seen a number of regional banks fail this year, and it's because the Fed was hiking rates so aggressively. And what happened was they hiked rates so aggressively, those financial institutions only were keeping part of their deposits actually on hand. That's pretty common practice again around for banks, credit unions. They keep part of the deposits on hand so that people can come in and withdraw cash. They invest the rest of it elsewhere. Well, a lot of them invested money and they made some bad bets, and they were buying treasuries, mortgage-backed securities when rates were much lower, paying a much lower yield. And then as rates have increased, people have started to withdraw money from those banks a little bit more quickly, and now they're in a position where they had to start selling those assets at a loss. And that's what caused all of those regional banks to kind of fail. That's the one common thread amongst all of them. Most of them were heavily invested in one sector. All of them were making some really bad bets. And that's because of the Fed. When the Fed hikes rates, it also devalues some of those other assets that they had on hand. So Fed rate hikes and regional banks failing, the two are connected to one another. But the hope is that, again, the Fed is going to start looking at the data a little bit more clearly, stop trying to overcook this thing, and let some of what they've done already take hold. The economy is a very large cruise ship. It does not turn like a jet ski. It's going to take some time to pivot. It's going to take some time to feel those effects of some of those rate hikes that they've already done. And then the jobs report on July 7th, so it's always on the first Friday of the month. These figures have been scorching hot this year. Scorching hot, just really, really resilient jobs market. Somewhat to the dismay of the Fed. They want to cause a load of pain. If there's too many people that are getting jobs, there's going to be more people spending money. And that's exactly what they're trying to prevent. So the Fed right now is in a position where they don't necessarily like the strong GDP numbers. They don't necessarily like the strong jobs numbers. When we got initial jobless claims on Thursday, it was also a really strong number. The Fed doesn't necessarily like all that information. They want to see, they're trying to cause pain. They want to see some of those effects of that pain. Kind of weird, but that's exactly where the Fed is at. So it's if the jobs market is, again, scorching hot, Fed is going to have more ammunition. Well, we can keep hiking rates. It doesn't seem to have an effect. Let's keep going. So again, all stuff that the Fed's going to be looking at, and we're going to be watching very closely what the Fed action is going to be. So that is it. I will talk to you in another month. I hope you have a great 4th of July. Hope you have a great month. And yeah, if you think of anything, let us know. It's our pleasure to help you. I love being a resource. I love to educate and help out. So let me know how I can assist. And as always, thank you all so much for your referrals. It means the world to me and my team. So thank you so much. Have a great day. Bye.